The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, that if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
Warren Buffett's late business partner and friend, Charlie Munger, famously said that investing isn't supposed to be easy. If it seems easy, one isn't paying attention. This adage rings truer in 2024 than ever. The stock market, despite recent highs in the S&P 500 and NASDAQ, is a minefield. Fortunately, legendary investor Warren Buffett has recently provided a roadmap for investing in 2024. In his annual Berkshire Hathaway letter, Buffett shared crucial insights on how to approach investing amidst market chaos. This letter reveals Buffett's strategies for not only surviving, but thriving in these unpredictable times. The heart of Buffett's advice centers around a concept he has championed for years: investing in companies with a moat. In simple terms, a moat refers to a business's sustainable competitive advantage. Buffett explains that at Berkshire Hathaway, the goal is to invest in businesses with strong economic moats, those that can withstand competition and economic fluctuations over the long term. He emphasizes that while some companies may excel temporarily, only those with enduring competitive advantages will continue to thrive in the future. A prime example of this is General Motors in 1998. Once a leading name on the Fortune 500 list, GM was an industry titan. Yet, within a decade, the company faced bankruptcy and required a multi-billion-dollar government bailout. This dramatic shift underscores the importance of investing in companies with robust, long-term moats rather than those riding the wave of temporary success. Contrast GM's fate with that of American Express. Despite economic fluctuations and challenges, American Express has consistently demonstrated a strong moat. Its established brand, extensive customer base, and unique business model have enabled it to maintain its competitive edge over decades. Investing in such companies with durable advantages is a key lesson from Buffett's investment philosophy. Buffett's checklist for successful investing in 2024 also includes assessing a company's ability to weather economic storms. In today's volatile environment, it's crucial to focus on businesses with the resilience to endure downturns. This approach is particularly relevant given the current economic climate of high inflation and interest rates. Furthermore, Buffett advises investors to be wary of those who claim to predict market movements with certainty. The reality is that no one can accurately forecast market swings. Instead, the focus should be on identifying fundamentally sound businesses with a proven track record of durability and competitive strength. Buffett first took a stake in American Express back in 1991, when the company was generating $14 billion in annual revenue and $749 million in profit. Fast forward to 2023, and those numbers have skyrocketed to $56 billion in revenue and $8.3 billion in profit. This dramatic growth illustrates the strength of a solid moat, American Express's ability to maintain its market position and profitability over time. Another crucial factor is future growth potential. Buffett describes this as finding companies that can deploy capital at high returns in the future. An excellent example of this is Buffett's investment in Coca-Cola. Buffett's journey with Coca-Cola began in 1988, when he bought a significant 6.3% of the company, making it a substantial part of Berkshire Hathaway's portfolio. At the time, many questioned the wisdom of investing so heavily in a company that seemed to have limited growth prospects. While Coca-Cola was a staple in the U.S., its low price point made it accessible to consumers in low-income countries as well. By 2023, approximately 75% of Coca-Cola's sales by volume came from international markets. This global expansion helped Coca-Cola boost its annual profit from $1.4 billion in 1988 to $11.3 billion in 2023. Buffett's initial $1 billion investment in Coca-Cola has grown to a staggering $40 billion thanks to stock appreciation and dividends. Now, let's turn to the third essential item on Buffett's checklist: good management. Buffett emphasizes the importance of investing in companies run by capable leaders. Effective management can significantly influence a company's performance and long-term success. The right team not only drives day-to-day operations, but also steers the company through challenges and seizes growth opportunities. Evaluating management quality in companies can be as tricky as it is crucial. Warren Buffett's investment success hinges not only on picking the right companies, but also on assessing their management. Identifying sincerity and genuine competence in business management is far from straightforward. Buffett evaluates management using two key criteria: their performance relative to industry peers and their ability to allocate capital effectively. Let's delve into these criteria with a concrete example. Apple Inc. Tim Cook, Apple's CEO, has been at the helm since 2011. Under Cook's leadership, Apple's revenue has skyrocketed to $383 billion, with a jaw-dropping $97 billion in profit. Cook's tenure is marked by pivotal strategic decisions that have paid off. Apple introduced groundbreaking products like the Apple Watch and AirPods, which have become integral to its product lineup. Furthermore, Cook shifted focus towards growing Apple's high-margin services sector. Revenue from services now represents nearly 25% of the company's revenue. The second criterion Buffett uses to judge management is capital allocation. It's essentially about how a company manages its accumulated profits. Companies that generate cash profits must decide how to use them. They generally have two primary options: reinvesting in the business or returning money to shareholders. Effective capital allocation is crucial for investment success. It determines whether a company can continue growing, innovate, and reward its shareholders. Buffett's investments reflect his belief in the importance of prudent capital management. Companies that reinvest wisely and return value to shareholders are often the ones that sustain long-term success. Buffett's wisdom here is invaluable. He explains that Berkshire Hathaway is structured to weather financial storms far beyond typical expectations. The company's strength lies in its diverse earnings streams and minimal cash requirements. In times of high market prices, it's wise to accumulate cash rather than rushing to invest. Buffett's recent silence in stock purchases suggests he sees the market as overvalued, mirroring past instances when he stockpiled cash before a significant market correction. In conclusion, Warren Buffett's approach to financial resilience is both straightforward and profound. By diversifying income streams, minimizing debt, and maintaining a cash reserve, individual investors can prepare themselves to weather economic storms and capitalize on opportunities. These strategies not only protect against financial instability, but also lay the groundwork for future success. In conclusion, Warren Buffett's approach to financial resilience is both straightforward and profound. By diversifying income streams, minimizing debt, and maintaining a cash reserve, individual investors can prepare themselves to weather economic storms and capitalize on opportunities. These strategies not only protect against financial instability, but also lay the groundwork for future success. Thanks for watching. Please like the video, subscribe, and share your thoughts in the comment section.